Real estate has been on an absolute roller coaster. For years, it's been pretty uncertain, but now the headlines are starting to hint at a comeback. So the big question is now the time to jump back in? And maybe more importantly, how do you even do that? Well, today, we're going to do a deep dive into one of the most popular ways to invest in the entire U.S. real estate market, the Vanguard Real Estate ETF, ticker symbol VNQ.
And really, this is the question on everyone's mind, isn't it? We've seen the market kind of reset itself, we've all been dealing with those high interest rates, and now it feels like the mood is shifting. People are moving from just trying to survive to cautiously looking for real opportunities again. So, is 2026 the year that a new cycle really, truly kicks off? Let's take a look at the evidence. Okay, so let's start right here. This quote from CRE Daily, it really captures the growing feeling out there. A lot of forecasters are starting to point to signs that things are stabilizing, that a recovery is beginning to take shape. But, and this is a big but, this is not a simple story where everything just goes up at once. The reality is way more complicated and, understanding those details is absolutely the key to making a smart move here. So, before we can even begin to analyze a specific investment like VNQ, we have to understand the bigger picture. Are we actually walking into a new real estate cycle? And if we are, what does this new cycle even look like? And this chart right here just perfectly illustrates that complexity I was talking about. It is literally a tale of two markets. On one side, you have these booming sectors like data centers and industrial logistics, right? They're just on fire thanks to massive trends like AI and e-commerce. But on the other side, you've got the traditional office sector, which, let's be honest, is still really struggling. So this is not a recovery where a rising tide lifts all boats, not at all. So, when you pull it all together, here's the picture the experts are painting for 2026. Money is finally starting to flow back into the market. We're seeing more deals get done. There's this feeling that we're finding a new equilibrium after all the shocks of the last few years. And get this, while demand for the best, highest quality properties is really strong, new construction is way down. That's creating a supply crunch in the most popular sectors. So yeah, the feeling is definitely getting better, but everyone is still moving very, very carefully. Okay, so that's the big picture. Now that we've got a feel for the whole market, let's zoom in on our main subject today. How does an ETF like VNQ actually fit into this really complex environment? So what even is VNQ? Well, a simple way to think about it is like a one-stop shop for U.S. real estate. It's an exchange-traded fund, an ETF, and it holds a big basket of over 160 different real estate companies and investment trusts. The goals here are pretty simple. Give you broad diversification at a really low cost. We're talking an expense ratio of just 0.12%. So instead of betting everything on one building or one company, you're buying a tiny slice of the entire market. But, saying you're buying the entire market can be a little misleading. So let's look under the hood. What are you actually buying with VNQ? And what you'll see right away is that this is not your grandfather's real estate portfolio. The top holdings are not dominated by old-school office buildings. No. Instead, you see the leaders in modern real estate. Prologis in logistics, American Tower and cell towers, and not one but two giants, Equinix and Digital Realty, in that booming data center space. And this is where it gets really interesting, because this chart visualizes that modern focus perfectly. It just confirms what we saw in the top holdings. You've got significant exposure to those huge growth sectors. Look at it. Industrial, telecom, and data centers make up a massive chunk of this thing. That diversification is so important. VNQ isn't making some giant concentrated bet on a struggling area like traditional office space. Okay, so we know what VNQ owns, but with every single investment, there's a push and a pull. There are forces working against it and forces driving it forward. And for VNQ, this conflict is incredibly clear, and it's really important to understand. And here they are. The entire investment case for VNQ in 2026 pretty much boils down to this one big battle. On one side, you have the major headwind, its sensitivity to interest rates. And on the other side, you've got this powerful tailwind from these huge long-term trends, what analysts call secular growth drivers, that are powering the specific sectors it owns. Let's break down that headwind, because it's a big one. Think of it like a seesaw. When interest rates, especially that 10-year treasury yield, go up, the value the market puts on future rental income goes down. It's that simple. Higher rates make it more expensive for these companies to borrow money, and it makes safer investments like bonds look a lot more attractive. This puts downward pressure on the prices of pretty much all REITs, and it doesn't matter how well their actual buildings are doing. This is, without a doubt, the single biggest risk for VNQ. But fighting against that huge headwind are some incredibly powerful tailwinds. And we're not talking about short-term fads here. These are multi-decade shifts in our entire economy. The AI boom is creating this unbelievable demand for data centers. E-commerce just keeps growing, fueling the need for modern warehouses. We have an aging population, which supports healthcare real estate, and the rollout of 5G, well, that requires more and more wireless infrastructure. These are the powerful engines running inside of VNQ. All right, so we have the full picture now. A market that's cautiously recovering, a diversified ETF focused on modern real estate, and this really clear battle between interest rate headwinds and these massive growth tailwinds. So now it's time to put it all together and answer that big question. So, is VNQ the right move for you? Well, based on everything we're seeing, the answer isn't a simple yes or no. The truth is, it depends completely on your own goals, your timeline, and honestly, your tolerance for risk. This is a strategic choice, not a one-size-fits-all solution. To help you decide, think of this as a checklist. VNQ is probably a good fit for you if, number 1, you just want simple, broad access to the market at a low cost. Number 2, and this is crucial, your time horizon needs to be long. We're talking at least 5 years, ideally, to ride out the inevitable ups and downs. 3, you have to be okay with stock market-like volatility. And finally, this whole investment makes the most sense if you believe the worst of the interest rate hikes are probably behind us. So let's just boil it all down to its simplest form. On one hand, the biggest reason to buy is that you get a low-cost, diversified ticket to the most important growth areas in modern real estate, and you collect a decent dividend along the way. But on the other hand, the biggest risk is that its price can get knocked around by big macroeconomic forces, especially those unpredictable changes in interest rates that have absolutely nothing to do with how good its underlying properties actually are.
And hey, what if VNQ doesn't sound quite right for you? Well, you have other options. If you want to make a much more focused bet on that AI-driven data center boom, you could just look at the individual companies themselves, like a Digital Realty or an Equinix. Or if your main goal is simply getting the lowest possible cost for broad real estate exposure, a competitor like the Schwab US REIT ETF, ticker SCHW, actually has a slightly lower expense ratio.
Ultimately, the decision to invest in VNQ really comes down to this. It's a bet on the long-term health of these key real estate sectors versus the short-term uncertainty of interest rates. And that leaves us with a final question for you. If you apply this kind of analysis, what's the one sector of the economy you're watching most closely for opportunities as we head into 2026? Let us know.